Canada may be looking to cut the policy rate before the US. The Bank of Canada has been keeping the policy interest rate at 5%. The governor of Bank of Canada said that the bank would start cutting the rate next month in June if inflation shows further signs of slowing down. Residential and commercial property owners with mortgage loans have already taken steps over the last few years to adjust to these higher interest rates that we have right now and have gone through over the last 2 years. Canadian mortgages are typically for 5 years or less. If you look back at 2022 when interest rates were starting to go up, then there's a large amount of borrowers out there who would need to renew the mortgages within the next 2.5 years. Most of these borrowers are expected to see their monthly payment go up by more than 60% if they're still on a variable rate mortgage. The central bank released its annual financial stability report. It mentions that many homeowners have been able to keep up with their mortgage payments, and that's despite rising interest rates. Again, people have adjusted already. In fact, mortgage defaults are at 0.5% across Canada. Sounds low being less than 1%, but the number of mortgage defaults was actually lower during the pandemic at 0.28%, and that's across all loans from all of the big banks in Canada. Do you remember when we had the mortgage deferral program? It was put in place during the pandemic. It allowed borrowers to miss a few mortgage payments with no penalty, and during that time, a total of $1 billion a month was deferred across 750,000 Canadian homeowners. This was during the pandemic, and people were allowed to skip their mortgage payments. There was just no way for the banks to take 750,000 phone calls from people who wanted to defer their mortgage payments. All of the banks collectively said no worries and let people miss their mortgage payments. And in the end, the interest that accumulated was just simply added back onto people's mortgages. But what about now? Why isn't the same mortgage deferral program being brought back? People are struggling after all with their mortgage payments. The difference is that the situation we have today is not a global pandemic. Central banks around the world have put up their overnight rates over the last few years to control inflation. And now today, about half of the country's outstanding mortgages have already renewed at these higher rates. The other half has not renewed and haven't felt the pinch of higher payments yet. This group of people are scheduled to renew over the next 2 years. They purchased their homes early in the pandemic in 2020 and 2021, and back then, the bank had the overnight rate at 0.25%. There are two groups of people who are going to see a huge shock in their payments over the next 2 years. First is the group of people that have variable rate mortgages, but also with a fixed monthly payment. Their monthly payments have not changed so far. They'll be looking to renew over the next 2 years with their monthly payments going up by 50 to 60% based on what the banks are saying. The second group of people have fixed rate mortgages. Their interest rate doesn't change like a variable rate mortgage would. What's not looking good for them, obviously, is when they also have to renew over the next 2 years, because the banks are saying that their monthly payments could see a 20% increase. But one thing we don't know is whether or not these increases also take into account the inevitable rate drops that we're expecting. We don't know how much the overnight rate will go down by, but we do know that it's very likely to go down this year. I wouldn't expect the central bank to bring down the rate quickly and by a large percentage. They're definitely not going back down to anywhere close to a 0.25% that we saw during the pandemic. The risk of a Canadian recession is no longer there, according to the Bank of Canada's governor. Canada's inflation rate went down to 2.8% in February from 2.9% in the previous month. If it wasn't for the 4% increase in gas prices during February, inflation would actually be down to 2.6%. But in March, inflation went back up to 2.9%. Whichever way you look at it, inflation continues to hold steady within the bank's target of 1 to 3%, and it would have to remain within this range before a rate reduction happens. Even though we're in a tight labor market, average wages went up by 5% in February. Businesses are seeing lower profits, which have led to several layoffs, but the perpetual effect of eventual decreases to the policy rate is that it creates opportunities for businesses to stimulate economic growth. We would see new businesses, but also existing businesses expanding, which leads to a stronger job market and higher consumer spending. Most market analysts are predicting the first rate cut to be 25 basis points. This would bring down the policy rate to 4.75%. This is actually the same level that we had in June last year. Even at 5%, it's lower than the US Federal Reserve's policy rate of 5.5% that was just announced on May 1st. And what's happening in the US right now is that their inflation rate is at 3.5% with a target of 2%. So for them, there's no rush to bring down the rate. A strong US economy benefits Canada, since about 3/4 of Canada's international trade is tied with the US. But right now, economic growth is slower in the US compared to Canada, which is why they're expected to hold their interest rates higher and for longer. And for that reason, Canada might actually cut rates sooner than the US, which for some might sound unusual since Canada would typically follow what happens in the US instead of making the lead decision. But I think it's important that we don't get too far ahead of the Fed. The drawback to lowering the rates sooner than the US is that a gap between Canadian and US interest rates can cause the Canadian dollar to drop even further against the US dollar. Over the past year, the loonie's been floating around 72 to 76 cents, and it's still in that range today. A weaker Canadian dollar can work against the Bank of Canada's progress to fight inflation. If we have a lower exchange rate, it makes imports from the US more expensive. And so these higher prices get passed on to consumers and could refuel inflation. So I think this is why the Bank of Canada is taking its time to assess when to lower the rate and by how much. At the end of the day, most businesses and households have already adjusted to the current interest rate environment. The wait for a drop in interest rates continues as we get closer to June, when it could finally come down. Let me know in the comments what you think is going to happen next month. If you enjoyed this video and you're new here, don't forget to subscribe. Thanks for watching, and I'll see you in the next one.